All right. Hey there, everybody. Good morning, good afternoon, good evening, depending on where you're at. I hope y'all are having a good Tuesday so far. Thanks, Mirza. And so, in this session today, we are going to talk about earnings for this week and walk through some potential earnings trade ideas um, that you may or may not consider taking yourself. So, let's go ahead and get started here. The first one I popped up here on the list that I wanted to walk through at least was Sky. I believe this has earnings tomorrow morning or no, today after market close, excuse me. So today after market close, Sky should report. There are two different ways I typically look at trading earnings depending on the chart. The first way I'll look at trading it is based off of a volatile move. That's usually my favorite way of trading it. And it goes off the idea that we may have a gap or a strong bar move on the day of earnings. And as long as that earnings isn't like on a Friday, going into a Friday, then see how it responds the rest of the week, right? So because this is after market close today, we'll see how it looks for the immediate market reaction, as well as what it looks like for the next few trading bars to where that encompasses potentially the next few trading days. Um, so that's one way. The other way is to look for the premium crush. So we'll take a look at prior earnings, see how they've reacted, and then kind of walk through a trade idea that might match it. So in the case of Sky, when we look here overall, oh, and already running a bit slow. There we go. Uh, Typically, right, we saw in the last earnings a strong, bit more of a volatile move to the upside, made a third deviation Bollinger Band snap. So that was already a good sign that the price would either stay in this bars range or continue higher. And over the course of the next few trading days, continued to the upside. When we take a look at this earnings announcement, we had a bit of a gap lower, trended down, but then did bounce back up to where it was in the same range prior. Here, we ended up gapping lower, did get a bounce for the high that day to kind of retest that range, but ultimately closed the day lower and then hung out there for a couple days before bouncing again. And then back here, we had a volatile move lower, eventually bounced back up, but never, at least within the next few bars, didn't quite get back into this original bars range prior to the announcement. Now, typically what I look for is if it's more of a non-event, right? If we stay within that bars range, I usually lean towards a premium crush trade. But in this case, we can see that at least a lot more often, even if the price did come back up maybe later on the bar or in that week, overall, we have seen volatile moves on Sky, right? We've seen gaps to the downside or gaps to the upside, like we saw back here. And so I'd probably look to play this as a potential volatile trade idea. Now, as we want to always remember, whatever capital you put out there around an earnings trade, please be okay losing 100% of that capital because anything can happen around the announcement. So we always want to be mindful of that whenever looking at these trade ideas. I try and keep them on the smaller side of risk, certainly for myself, and then play them that way. Now, one thing to point out with Sky is unfortunately it is only a monthly expiration. Now, that may benefit some in regards of a volatile trade idea. If Sky had a bit more of a non-event overall and we didn't really see much action, then I probably wouldn't even do a trade on that symbol because of how much time there is left until the expiration itself. Even though the option premium does build into earnings announcements typically, because there's still basically 31 days left on this expiration, it's not going to get the same sort of premium crush after the earnings announcement that a this week expiration would, right? Like a weekly. So keep that in mind. Let's pull up the option chain here. And so we can see the anticipated range for this expiration, which encompasses earnings, is about a 7, just shy of an 8-point move. And so makes it a little difficult because of the strike increment being 5 points. But that's okay. We'll still price out something. Roughly an 7 to 8 point move to the upside would be right around um, eight, 84, $85. So right around this strikes range. Vice versa, if we are looking at a 7 point move to the downside, that would be around 70. So what we could look at doing here is a double vertical spread. Let's price that out and see what the cost is on it. So it looks like right now the cost is around a $3 cost basis, $2 profit potential. Not really the best risk versus reward. I look for that to be a little bit better typically. But once again, that's kind of the struggle here with it not only being a June monthly, but the strike increments being 5 points versus the anticipated range only being about 7. That being said, if we were to see that 7 point range of a move, especially if it happens sooner than anticipated, to where our short strike was at or in the money, that should allow for a profit on this overall trade idea. So if you're willing to put a little bit more risk out there, you can. You could, of course, look at going with just longs. The downside of doing that is if you went with something like the 75.80 strike, unfortunately, that's going to be a bit rich, right? The mark is basically $3 roughly on each side. Let's just call it 620 total risk if you got filled at the mid price. And so because of that, you're cutting it close that if you get a move within the anticipated range, the intrinsic value on these two strikes would at least cover the risk, if not maybe lock in a small profit, or depending on theta, of course, you might lose a little bit, right? The downside of going out of the money, right, going to the 70 and 85 strike respectively, is that not only now do you need a point move to those levels, which is already where the anticipated range is at, but you really need it past those levels by 317, which is the cost basis here. And because of that, right, that means you basically need a 10-point move really to get to break even, and anything above that to be profitable. And that's based off of more intrinsic value. But you guys get the idea. So that's why I'd still lean towards probably a spread in that case. It's about a similar risk to what we see here, but you don't need as big of a point move for that to work out. Up next, let's talk about target. If Thinkorswim will not be so slow for me. There we go. On the Florida Trader, we're looking at specific earnings trades right now, but I'd be happy to look at that afterwards. So, or we could look at it tomorrow, certainly, during my normal session in here. But today, this session is specifically around the earnings trade ideas for this week. So we'll look at it at the end of the session here. Really quickly with target. So the same idea, guys. We're either looking for gap moves or more of a non-event. At least out of the last 3 earnings that we've had pretty strong gap moves to the upside here. Not as strong of a gap move lower, but it did trend lower after. So obviously it doesn't hang out, at least not the last 3. So I'd be looking for that more volatile play. Target, of course, has weekly execution, so that's going to benefit us, as well as the striking event. And the anticipated range right now is about 1025. So if this is what it's looking like going into the close, because I believe target are tomorrow morning, if I remember correctly. Double check here. I'll just look at my cheat sheet over here. Yeah, targets are before open on Wednesday. So With that being said, if this is what it's looking like into the close, right, it doesn't move too much more dramatically than this, then a 10-point anticipated move would be around 65 and 45 respectively. For here, I'd probably lean towards something like a 2.5 or a 5-point width spread. So let's start with a 2.5 width, where our short strike is 65 and 45 respectively. Now, the downside on the call side is we technically only have dollar strike increment. Use a 2-point width spread or a 3. I personally would go with a 3. And so you can see it's about $1.60 cost basis. The max profit potential is on the put side where it's a 3-point width spread. That's $1.40. The max profit potential on the call side is only about 90 cents. I usually like it to look a little bit better than that personally. If we did a 5-point width spread and kind of encompass that range, then we're looking at about a 263 cost basis that allows for a 234 max profit potential. And then once again, if we do get at least that 10-point move or greater than that, based off of a gap, should allow for a nice win. The one thing I do also like about either one of those trade ideas is notice on the call side, the long strike is 162.50. And then you can see up here that the ATR trailing stop is right above that level, right? It's at like, it's okay. Hold on, guys. Okay, sorry about that. So the ATR trailing stop is right up here. That's right around that 167.50 of the short strike. If you did the 2.5 width spread, it's certainly above 165. So the idea is if we get a gap up, but ultimately resistance still wants to win out, you'll still be in the money on the call side for these strikes. Obviously, from a daily chart perspective, there's nothing to stop this from going to the downside, if you will. So that's what I'm seeing for target. Up next, of course, will be ADI. So let me pull that one up. So on ADI here, strong gap up last time, stayed in that range. Here we had a strong gap to the upside. Is this ADI? No, it's not. I was like, this looks like target. Okay, let's see if the chart will update. There we go. All right, so ADI last time had a little bit of a gap up, but then pulled back, kind of hung out in that range. On this earnings, we basically hung out, right? Non-event. Here we had a little bit of a volatile move, but then bounced up and hung out. And then here we did have a gap to the downside. So, a little bit more of a mixed bag than maybe some of the other ones that we've looked at. I would argue, even though I personally prefer playing more volatile moves, this one seems to act a bit more like a non-event. Or if it does get a little bit of volatility, it's not uncommon for it to pull back within that same range. So this is one of those cases where I'd probably lean towards a premium crush trade, right? Something where you can just play the theta decay and if that works out. Now keep in mind, just like on the other trades, if the other trades didn't get a volatile move, if they remained flat, you're likely losing that capital, right? So it's going to end up a loss. For this trade, if we do get a volatile move that does not come back down towards the underlying price where it's at now, then understand you will lose on this trade. You have to be okay with that. But if you like, the consistency of how it usually has more of a non-event, then you might look to play the premium crush. Right now, we're kind of right in between the 215, 217.50 strike levels. So it just kind of depends on which one you want to go with. I'll just go with the 215 strike here. The anticipated range is about 649. So probably looking at something either between I'd probably lean towards a 7.5 with spread myself. So let's do that here. So that's a 7.5 with spread. That's about a 518 credit, 232 risk. So the idea is as long as we stay within a $6.49 range, we should see a bit of premium crush on this that ideally allows us to lock in a profit. If you prefer the center of that to be at 217.50 and to go with 210, 225, I certainly like those rounder numbers for the wings. So I get that. Similar credit versus a risk. In regards of levels, the 10 period simple is at 211.50. So I do like the idea of having this butt up either at the 210 or 207.50 strike, right? Both of those would be underneath the 10. So if we get a move down into that 10 period simple, it holds support, and then we try and get a little bit more of a bounce back up towards the middle strike, right? That should end up working out nicely. Now, if this is a little bit heavier on the risk than you'd prefer, you could look to maybe narrow this to a 5-point spread if you wanted to. It's certainly a better risk versus reward. Just keep in mind that's reducing the range that you're allowing the underlying price to move. So you really need it to come back down to try and work off that premium crush. Vice versa, another way you could look at doing this is by turning it into more of an iron fly, or excuse me, not an iron fly, an iron condor. That would be about $1.24 credit versus $1.26 risk. So a pretty even risk versus reward. And that's right around that anticipated range once again. So the idea is as long as you stay within that $6 move, the idea is you would get the crush on premium to still lock in an overall profit there. Now, the next one I'm going to talk about is NVDA. I know that's probably what a lot of people are curious about for earnings. Let's pull that up. So, waiting for the chart to load here. Let me load up the option chain while that's working. There we go. So NVDA does have a bullish divergent bar going into the announcement. That will be interesting. But let's look at prior earnings. So here we had a nice gap to the upside and then trended higher a little bit. Here, non-event, I'd argue, right? Just kind of hung out. Let me zoom in here for these levels to look at a bit more closely if it lets me. There we go. So yeah, here a bit more of a non-event, right? Just kind of hung out after the earnings, a little bit of a pullback. So more likely the premium crush trade would have worked better on that one. Here you had a bit of volatility to the upside, but then it pulled back. So depending on your strike level, the volatile trade idea might have worked right at the open if you took the quick win. Otherwise, the iron fly or iron condor trade idea probably would have worked better. And then here you had a gap up. So this is really a mixed bag. Now I know a lot of people would ask about it, which is why I put it on my list to talk about. But to be quite frank, I think you have slightly better setups with some of the other symbols we talked to, at least in regards of chart pattern, right? Because they have a little bit more consistency. Like ADI, we've seen the last 3 out of 4 earnings chop a bit. So premium crush, right? Target seems to have a bit more of those gap moves. So the volatile trade idea. But NVDA is basically 50-50 on both. So I'll walk through both different charts personally. I'd lean towards the volatile trade because even on because you had gaps on 2 of them, and then on this one, even though the premium crush would have worked, the volatile trade might have worked at open. So that's the one I would lean towards, but we know it's not always how things work here. So I'll also walk through a more premium crush trade idea. But here, the anticipated range for NVDA is 75 points. We're basically right around 950-ish. Once again, we're kind of in between those strikes, but I'll go with 950 on that number. That means to the upside, we're looking for a move up to around 10.25. And to the downside, we're looking for a move closer to 8.75. So on something bigger like this, where it has a little bit more of those moves, you could do something like a double vertical spread, right? Let's just look at 2 5-point width spreads here, where the short strikes right at that anticipated range. So you're looking for at least a 75-point move, if not greater. And you can see that's about a 240 cost basis versus a 260 profit potential. So not a bad risk versus reward there overall. However, usually if I'm playing the volatile trade idea and it looks something like this, I really like doing stuff along the lines of debit butterflies. And the nice thing about this strategy is it can keep things relatively inexpensive, but still allow for a forgiveness factor if it goes completely in the money compared to a standard butterfly, and still allows for a really nice profit potential compared to the double vertical spread. So just pricing things out. Once again, we don't know which way this will, have the quote unquote gap move. We just think that there's a good possibility of volatility. So we play both sides. And on the put side, this is about $1.42. So let's price out the call side. We'll do the same spread width, right? 10 points on the debit spread of the butterfly, 5 points on the credit spread. And for this one, we're looking at about $1.25. So in total, you're spending about $260. Let's just round it up, say it's $270. So about a $270 cost basis. That's not much more than what the double vertical cost us. Now, it does cost a little bit more risk. And of course, you always want to keep that in mind, but it's not that much greater, in my opinion. And that being said, the profit potential, right, that max profit potential is a lot greater. And that's just a fact. Instead of it being around a 260 profit potential versus a 240 risk, here we have about a 270 risk for both of those butterflies combined, but a max profit potential if you pin on one side or the other at 730. So excellent risk versus reward. But let's say NVDA has a 100-point move, right? It really gets that kind of gap move and starts trending and never comes back. The benefit about a debit broken wing butterfly, how it's set up, is if it goes completely in the money on one side or the other, it will still be worth $5 on that butterfly spread. And that's because of the difference of spread width. So 5 minus our cost basis of 270 would still allow for a 230 profit potential. Pretty decent risk versus reward. Now, I know there are other traders out there who think, it's not likely this is going to gap. They're looking more at this just remaining flat. And so if that's the case, and if you have larger pockets, an iron fly is usually a really fun way to trade this, because you can get a lot of premium because of that uncertainty going into the news. While, if nothing happens, getting a really great crush on premium. So this is about a $55 credit, about a, $20 risk or so. So not a bad, risk versus reward if you have a larger account. Obviously, if you trade small accounts like I typically do, this is probably not something you want to do, but that's okay, because you can still play the premium crush through an iron condor. And an iron condor, you're looking at about a 238 credit, 262 risk. Once again, not a bad risk versus reward. And this way, you can still look at the idea that this is going to be a bit more of a non-event. And both of these credit spreads can experience that premium crush to where it's a really quick locked-in profit. So you could, of course, if you like that better risk versus reward of an iron fly, you could also do something like this and only make it, let's say, a 25-point width spread on each side. The downside is, once again, you're not, even though this is an excellent risk versus reward, right? 23 profit versus a $2 risk. The downside is you're really not letting NVDA move. So let's say NVDA moves $50, right? Well, $50 would put you outside of the money on this narrow iron fly, but on the one that's a 75 point width, or on the iron condor, right, where both of those credit spreads are at the 75 anticipated range level on the put and call side, those would be a bit more profitable overall, right? Or at least break even. This would be a full loss. So it's a great risk versus reward. If you really think it's just going to remain flat, don't let me stop you from doing it. But like I said, personally, you're a talker today. Personally, I would lean towards the volatile trade idea myself if I were wanting to play NVDA. But that being said, like I said, I think some of the other ones we walked through here have a little bit better of a risk versus reward scenario. And then the last one I wanted to talk about here was INTU. So let me pull that up. Okay, there we go. I was like, I swear I typed that in. So these are things trading all throughout this week, both AM and PM announcements. So let's see here. On this earnings, we had a little bit of a gap to the upside. Here, we definitely had a gap to the upside. Here, we kind of opened a little bit lower, but then trended higher. So the iron fly trade idea probably would have worked at some point that day. The volatile trade idea might have worked at the high of the day. And then here, we had a volatile move lower. So overall, this one seems a little bit more like in the gaps, right? At least that's how I would look at it. So let's pull up INTU. The anticipated range on INTU is 31.92. So once again, you could look at this with the debit broken wing butterfly. You could also look at this just as a double vertical spread. So in this case, we're roughly right around 670. It's roughly a 30, point range. So 700 is going to be the one side. I would look probably 635-ish, given where we're at, is the 640 really to the downside. We'll do a 5-point width spread. And so you're looking at roughly a 215 cost basis. You might consider bringing this put side up a little bit if you wanted to. There we go. That's about a 230 cost basis, 270 profit potential. Not a bad risk versus reward. Once again, if it does go at least a 30-point range up or down or greater than that, you'll be at or in the money of these spreads. That should allow for a profit. In regards of levels, notice the 10-period simple on INTU. Let me hover over it so if it wants to give it to me. 646.29. So that would be right by the long strike here on the put side. If you wanted to maybe bump that up a little bit so you could encompass the range, I would totally get that. That's going to increase the risk by about 245. But that's still a pretty even risk versus reward. And this way, if it does gap down but hold the support of the 10, you're still partially in the money on this spread to ideally close it out, at least for break even, if not that profit. And so those were some earnings trade ideas for this week to maybe consider. Florida Trader, I'd be happy now to bring up AZN. So let me pull that up over here. And then that will be my time. Oh, try that again. Like a weird version of Amazon. Yeah, Chuck, I would agree. There's a lot of premium up on NVDA, certainly. So that's why I would totally understand if you wanted to do more premium crush style trade with the idea that the market makers kind of just suck all the money out of those options. Um, but if it even what I would personally look at is on some of these other semiconductors that have reported. It's not that they haven't had bad reportings, but the market has almost kind of been like, "Oh, okay," and it's like dropped the price down. So I could certainly see that being the case where it's had this beautiful run this year. It comes out, everything's good, but there's nothing that's like a wow factor, if you will, in the report. And so therefore people are taking profits and it kind of causes a gap to the downside. I would almost, if it is going to have a gap move, that's what I would be anticipating, unless there's something wow that comes out on the announcement that people are anticipating. That's where I could see maybe that volatility coming in. But otherwise, I would not be surprised if it's a premium crush trade. But that's why I said NVDA to me is a little bit on the riskier side for an earnings trade compared to some of these other ones. And I appreciate you. I'm certainly trying with her right now. So thanks for that. And we can also take snow really quickly. So let's look at AZN. We'll look at snow, and we will end out our day here. So in regards to this is a great all-time high, right? Certainly doesn't look bad, Florida trader. I will say though, what I'm not a fan of right now is even with this gap up, the Bollinger Bands are not budging, right? And so that to me is not necessarily a good view of things going higher. Now, maybe if we continue to stair step up tomorrow and it kind of forces the Bollinger Bands to flare open, I could see something like that. But right now, with the fact that the Bollinger Bands are flat, it tells me they're not really anticipating that move. And some of the other indicators that would agree with that is momentum's trying to reset. So that's more a consolidating to pullback signal because it's off of bullish exhaustion. We have more of a consolidating signal right now in the compound breakout tool. We had a pullback signal. We pulled back to the 10 that basically held, and then it has canceled out here. So that might help the bulls. But with how the Bollinger Bands and the momentum are, I view that more as a consolidating signal over anything else. Let's pull up the weekly chart really quickly. Might give us a little bit better insight. If the weekly will pop up for me. So the weekly chart momentum is getting a bit high, but it looks like it's actually started to adjust the axis higher. So what that tells me from a weekly perspective is we could actually continue to the upside until you start to get a few red bars in a row. This might keep going. Certainly the bullish signal on the compound breakout tool is valid. We have energy from a squeeze firing. We did print recent true lows, so that's helping things out. You are attempting to form a bullish diversion bar this week. So if that prints, it has a decent follow through rate on bullish divergent bars, getting that higher high. So that might help it continue up. I'd still be a little cautious because of the daily chart. What we could see on the weekly is basically it consolidates here, allows the 10 to catch up with the price. And then if that holds, that could be a new leg higher. I could see something like that. What I'd be watching for on the daily chart for any signs that that might happen sooner is for these Bollinger Bands to start to open back up. If I start to see that, then I'd be a bit more inclined that it's going to happen sooner than later. Otherwise, I would not be surprised if it didn't really necessarily give much back, but it consolidated here for a little bit, allowed the weekly to at least take a bit of a breath. And then if it can hold support, play for the next round higher. So I hope that helps you out. But beautiful move today. Great follow through on the daily bullish divergent bars here. I wish I saw this yesterday because that was a nice bounce to the upside there. And AZN has a really good follow through rate on the daily chart. So both of those followed through on this bar for the 3-bar rule. And then let's take a look at snow. And then let me pull it up on the option chain as well. Try again. There we go. Okay, so yeah, huge gap to the downside last time. Let's see. This one had a little bit of a gap up. On this earnings, we had a gap up, pulled back into that range, but then trended lower. So depending on where your strikes were at, what the anticipated range was for that earnings, you might have been able to take a profit on both the call and the put side of the volatile trade. Certainly, the iron fly at some point that day probably would have worked out. And then here we had a gap down. So I would argue this one has a bit more volatility to it than not. Happy to walk through both trade ideas there, but let me pull over the option chain now. So the anticipated range on the option chain is about 1543. We do have that similar situation with strike increment where it goes down to $1 on this side and stays on a 2.5 width spread on this side. So if we're looking at something like a double vertical, just be mindful it's going to be a little bit different of a profit potential one way or the other. But the anticipated range is basically $16. That would be up to 178-ish on the call side. So let's just encompass that range here. To the downside, that'd be around 147-ish. So we did a 5-point width spread. So let's just do the same thing. We'll do it on this side over here. So that's about a 245 cost basis, 255 profit potential. Not a bad risk versus reward. Strike wise, you're not quite below the ATR trailing stop from the looks of it on the daily chart, right? So you're almost kind of looking for a break of that level. You may consider adjusting the strikes up a little bit if you're concerned that maybe it gets a little bit of volatility, but not enough to break that support. So let's zoom in here and see if we can't see where that strike level is. On the call side, I'm more than fine with that because it's the 100 that's at 180. So there's a lot of room to play up to that side of things from a call perspective. Where's this exact number? It's probably right around 152-ish, looking at where the Bollinger Band is at. So let's call it 152. And to help keep the risk maybe a bit smaller, given how that close that is, let's do a 2.5 width spread on this side. And then we'll do this as a 2.5 width spread on this side. And that's about a 136 cost basis. If you want it to bump it up to the higher strikes, it's about 147, 103 profit potential. Not a bad risk versus reward, not the best. I usually personally like it to be a bit more even, 1-to-1, if not obviously a greater profit potential than risk. So that's a little bit less than that. If you think it's going to be more of a non-event, right? Or even if it does get maybe a little bit of volatility, maybe it's something like it pops down, holds support, and immediately jumps back into this range. Then an iron fly would probably be more of your friend. And for a 15-point range off of 160, 145, and 175 would be your wings. That's about an $11 credit, 391 risk. So not a bad risk versus reward necessarily. If you're in a smaller account and want to look more at a spread, I get that. I'd probably bump up that strike a little bit. So that's roughly a $14 credit, 136 risk, with the idea that you stay within that 15-point range and allow the theta decay to work in your favor. So once again, kind of depends what you're looking for. I'd probably lean towards more of the volatile move on this one as well. But also, like I said, fair warning, that's usually my preference on earnings trades. But you might be a little cautious of that. If it can get a bigger gap move and disappoint, then maybe it can break through that level. Price support is down around 145, so that would certainly work within the anticipated range. If it breaks the ATR but holds price support, that would work out for that trade idea overall. Um, but I hope that helps you out, Chuck. So thank you guys so much for joining me. As always, may the trade be with you, my fellow Jedis, and I look forward to talking to y'all next time. I will be back on the mic tomorrow for my normal session, so we can certainly see how some of these might have worked out, whether they're overnight tonight or tomorrow morning. And then, of course, tomorrow when we're in here, it's more of Q&A. So whatever questions y'all have in general, like Florida Trader wants to look at AZN, or if it's a question around a strategy, a chart setup, I am more than happy to spend that time answering those questions and going more in depth. So we'll have an hour tomorrow that will be at I believe 10:30, remembering correctly. 10:30 to 11:30. So feel free to join me then. Of course, Chuck, not a problem. Y'all have a great rest of your day though, and I'll talk to y'all again tomorrow. Bye guys.